Welcome back. In this video, we will discuss what is accounting, why is accounting required, and what are the different types of financial statements with the help of a simple example. If you find this video useful, please share it with your friends and colleagues. And also, don't forget to like this video. Thank you. Accounting is the process of systematically recording financial transactions in a business. It also involves summarizing, analyzing, and reporting the financial information to its stakeholders. Accounting, in simple terms, is the language of the business. It is very important to maintain proper accounts for any business as it helps provide transparent and reliable data and information to make the important business decisions. Accounting consists of two processes, bookkeeping and management reporting. Bookkeeping is the process of recording and summarizing financial information. It involves recording day-to-day transactions like sales, purchases, expenses, and summarizing this information in the form of financial statements. Bookkeeping is the most important process or the backbone of the accounting process. Management reporting. It involves data analysis and providing reliable and meaningful information to the management for performance assessment, future planning, and decision making. There are a number of interested parties who want to look at the financial statements of an entity. Few of them are listed here. Accounting information is required by the management for planning, budgeting, and making important business decisions. It is required by the employees to understand the business performance, required by financial institutions and banks to assess the balance sheet strength and ability to pay interest on loan, required by the customers and suppliers to assess the business continuity and determine the creditworthiness of the company, required by the government to determine if the company has complied with the regulations and paid appropriate taxes on profits. It is required by the competitors to assess the performance and determine competitive strategy. It is also required by the investors and analysts to understand the cash flows and return on investment generated by the company and to assess the current performance and forecast the future cash flows. So, accounting is important for various stakeholders. There are three types of financial statements. The first is the income statement, the second is the balance sheet, and the third is the cash flow statement. Income statement is the statement of revenues, expenses, and net profit during a particular time period. Balance sheet is the statement of financial position of the company as at a particular date, and the cash flow statement shows the cash inflows and cash outflows from the business during a particular period. Now, let's understand each of these financial statements one by one. Income statement or profit or loss statement shows the entity's income, expenses, and net profits earned during a period. It shows how the revenues of the company has translated into net income during that period. Income statement begins with the revenues, then we deduct the cash expenses which is the cost of goods sold and selling and marketing expense. Then deduct the non-cash expenses like depreciation to get to the earnings before interest and tax. From that, we deduct the interest and taxes to derive the net income of the business. Net income is very important for business sustainability. Income statement basically tells the revenues, expenses, and net income generated during a particular time period. Let us understand with the help of a simple example. John has started a business of selling dress material with $1,000 on 1st January 2020. He purchases 100 meters of the dress material from his supplier at $9 per meter. He sells this dress material for $20 each. At the end of the month, John has no material left. Apart from the material purchase, he has also incurred an additional expense of $100 for marketing his material. We are required to prepare the profit and loss statement for John. So in this example, John has sold 100 meters of dress material at $20 each. So the revenue or sales for John for the period 1st January to 31st January is $2,000. The cost of the dress material is $9 each. So in total, the cost of goods sold is $900. So the gross profit made by John during the period is $1,100. The marketing spend associated with the sales of products and services during the period is $100. Ignoring the interest and taxes, the net profit for John during the period is $1,000. Now, moving to the balance sheet. Balance sheet is the statement of assets and liabilities and equity of a company as at a given date. It is a statement showing what an entity owns and what it owes to others and what its owners have invested in the business. Assets, which is what the entity owns, is equal to liabilities, which is what it owes to others, plus equity, which is the amount invested by its owners. Now, continuing with our previous example, let's assume that John has invested $1,000 equity in his business. On the day of investment, his balance sheet would look like this. On the asset side, he has invested $1,000, so the equity of John's business is 1,000. There is no liability for John as on that date. The equity invested in the business is the cash available in the business on 1st January 2020. So the amount which John's business owns is cash of $1,000. So the assets which is cash is $1,000 as on that date. When John buys the dress material for $900, his balance sheet would change. So the cash gets reduced to $100 because he has paid $900 for the purchase of dress material. And there is an inventory of $900. So the cash gets converted into inventory. There is no change in the equity investment. So the total of the balance sheet remains $1,000. When John sells all the dress material, his balance sheet would change. The inventory of the business becomes zero because all the dress material has been sold. The cash of the business increases. The opening cash was $100. The inventory gets converted to revenues of $2,000. out of which he pays 100 for marketing spend. That means that cash balance would increase by $1,900. So the closing cash balance for John would be $100 plus $1,900, which is $2,000. The equity of John increases by $1,000, which is the net profit earned during the period. So the closing equity would be opening equity plus net profit. Opening equity is $1,000 plus net profit, which is again $1,000, is equal to $2,000. So now John will have 2,000 cash and 2,000 equity in his balance sheet. Let's look at the third financial statement, which is the cash flow statement. A cash flow statement shows how efficiently a company manages its cash. It shows how much cash a company has generated from its operations and how much of it was expensed and retained during a period. Cash flow statement consists of three parts. The first one is the cash flows from operating activities, then the cash flows from investing activities, and the cash flows from financing activities. The sum of these three parts is the net cash inflow or outflow during a particular period. If we add the cash balance at the beginning of the period to the net cash inflow or outflow, we get the cash balance at the end of the period, which should tie to the cash available in the balance sheet. Continuing with our previous example, let's look at the cash flow statement of John on 1st January 2020 before he purchases the dress material. So there is no cash flow from operating or investing activity because there is no activity on 1st January 2020. The equity investment made by John is $1,000. So the cash flow from financing activities would be positive $1,000. The opening cash balance on 1st January 2020 is nil. Therefore, the closing cash balance would be $1,000. When John purchases the dress material, his cash flow statement would look like this. Cash flow from operating activities would change from 0 to minus 900. This is because John has used $900 in purchasing the dress material. So the inventory for John increases by $900. So the cash flow from operating activity would be minus 900. There is again no cash flow from investing activity because there is no capex investment. And there is no cash flow from financing activity because there is no further equity investment in the business. So the total cash inflow or outflow during the period is minus 900. If we sum up with the opening cash balance, we get the closing cash balance of John at the end of 1st January 2020, which is $100. At the end of the month, John's cash flow statement would change. So the cash flow from operating activities would be $1,900. This is because the net income generated from the business is $1,000, an inventory reduction of $900 because all the inventories have been sold during the period. So the cash flow from operating activities is $900. There is no cash flow from investing activities because there is no capex. There is no further equity investment. So the cash flow from financing activities would again be zero. Total cash inflow or outflow would be $1,900. If we add the opening balance of 100, we get the closing cash balance of $2,000. This closing cash balance is the same as we had in the balance sheet, which is $2,000. This is how the three financial statements look and how each of them are related to one another. Hope you enjoyed this session. If you find this video useful, please share it with your friends and colleagues. And also, don't forget to like this video. Thank you.